Morning, everybody. Well, thank you for attending this webinar at this time of the morning. This time last year, we were sort of running webinars almost weekly with everything that was going on, trying to help all our clients. But hopefully your business is back to reasonably normal levels of trade, even if the circumstances in which we're working are anything but normal. So the subject of today's presentation, of course, is employee ownership trusts. Just wanted to tell you a little bit about who A4G are, really. So that's my whole team on our development day that we have on the 1st of February. That's me in the middle. I'm either trying to look thin or it was quite cold, and maybe the coats are a clue to that, really. But we're a firm based in Kent. We're a few miles down the road from Brands Hatch. But increasingly, we've got clients all across the country now, particularly in the last year. All the sort of help we've been able to give to get people through the crisis has brought us clients in from everywhere. We're pretty much dedicated to owner managers. That's our thing. We understand what the 8 key needs and wants are of owner managers, and we've got all sorts of different ways that we deliver services to help them with that, providing advice, support, planning, etc. All of our clients have 2 main contact points. We call them the principal advisor, who's the person that will give you the advice and the person you will call when there's a massive problem, and then the client manager, who's the one who sort of looks after the more traditional side of your affairs, the accounts, the tax returns, your accounting system, has the relationship with your bookkeeper, etc. I've been told that I need to remind you all that there will be a Q&A at the end. I think if you sort of dangle your mouse towards the bottom of the screen or at the top of the screen, you'll see some bars will come up. I think you should be able to see them on my screen, but there's just a Q&A bar in there, and you can type a question in, and then I'll run through those with our other speaker at the end. Our speakers today are myself. That's back in the day when I used to wear a tie, and David Rubin, who's a partner at Postlethwaite. So what I just want to talk to you about for a few minutes is just exiting your business. There's a few reasons that you might want to sell. The first one is that you feel that your business has peaked, and that this is the right time to sell, and maybe somebody else can take it on to another level. It may be that you're thinking about retirement, or there's health reasons why you need to step back from the front line. That's the most common cause of people selling their business. Possibly your business is worth more to someone else than to you. Now, that doesn't happen that often, but occasionally there might be a buyer out there who is in some kind of connected industry, and they know that if they take over your business, then they can sell whatever it is that they do to your customers. They can sell whatever you do to their customers, and they can also get them all under one roof and reduce the overheads as well. So it's quite possible that there are buyers that your business is worth more to them than it is to you. So that's a good reason to sell. Or maybe you've just had enough. I think we've all gone through a lot of emotions in the last 14 months, and I know that there's a few people that have looked over the other side and decided that actually, retirement isn't for them. But there's also quite a few people that have thought to themselves, do you know what? I need to get out of this industry now, and I want to go and do some other things. So the ways that you can sell is, first of all, you can sell your shares, and that's a fairly straightforward process, even if the deal with the third party might not be. The second one is that the company that you own, and I'm assuming that most of you run limited companies, that the company sells its assets and goodwill to a third party, and then you retain the company, which is now full of cash, and then you can either liquidate that company or maybe just use it to reinvest that money into whatever investments you want to. And there's pros and cons of those two ways of doing things. Normally from a tax point of view, people will want to do the first one because you get your entrepreneur's relief and you'll only be paying 10% tax on the majority of the gain. But sometimes a buyer doesn't want to inherit the past and whatever skeletons might be in the closet. Even if you haven't got any, they might consider that that's the possibility. So, don't ignore both of those two potentials. The third one is that maybe you've got somebody who wants to take over the business. They haven't got the resources to pay you much. So perhaps what you do is you license the name and your customer base, and you carry on owning the company, perhaps even owning the fixed assets that are in it, and then swap the names with this new company set up with the person you've done a deal with, and then they pay you some money for however many years. It could be a fixed amount, it could be a percentage of their profit, all sorts of ways of doing that, and 1,000 different variations of those deals. The obvious question is going to be, what's it worth? Because if you're retiring, then you need to know how much you're going to have to live on. So historically, the traditional way of valuing an owner-managed business will be net assets plus goodwill. So the net assets being the figure that appears on your balance sheet on the end of year accounts or your management accounts, if they're good enough quality, plus something for the goodwill. So the goodwill is, effectively it's future profits of this business. What is that worth? But it's your customer base, it's your brand, it's your domain names, it's your telephone number, it's all of these intangible things that cause customers to come back to you, and most of all, it's your reputation in the marketplace. The other way is to value it on a PE ratio. So looking at what profit the business is making after tax, and then a multiple of that. So, you can see what the PE ratios are for all listed companies. You're not going to get anywhere near those sort of levels because, they are relatively low risk because people are buying small shareholdings, whereas somebody's taken a much bigger risk in buying your business. But nevertheless, a multiple of that figure. The sort of trendy way of valuing businesses at the moment, which seems to be all the sale agents seem to be doing this, is a multiple of Ebitda. So Ebitda is earnings before interest, tax, depreciation and amortization. And we can look at your accounts and work out what your Ebitda is, and then it's a multiple of that plus surplus cash. So surplus cash being whatever balance your bank account never drops below, anything above that is surplus cash. So those are the three ways of valuing it. We've got some valuation models that we could do if anybody would like us to do a valuation, and we can sit through a meeting with you and just show you how those are all put together. Who are you going to sell to though? Well, it could be a third party, somebody you've never heard of, never met, going through an agent. There are good agents and there are bad agents. What you want is an agent who's got lots of people that they have access to, a big database of potential buyers who will find somebody that you would never have found. So there's going to be fees for that. Sometimes those fees will be up front because the agent, feels they're going to do quite a bit of work or advertise it. Need to be very careful what you sign up to here. Some people have found themselves signed up for sort of 3 years, unable to sell their business even to somebody they know without paying a percentage of it to an agent. So you need to read the small print in those deals. There need to be some kind of due diligence on the buyers as well. These things can go on for 6-9 months sometimes, and you might have wasted all of that time on somebody who's just a bit of a time waster, who hasn't got the resources to buy your business, and then you're back to the drawing board. One of the things that's going to come up is how long will you have to work? Now I've seen clients that have found a buyer, and then the buyer then is making a proposal that it's paid over 4 years and that they have to work there for 4 years. And they look at it and go, well, hang on, I could earn just as much money by carrying on running the business myself. So, this is important, and whether there's options for you to leave in certain circumstances, etc. The big thing is, will employees and competitors find out? Now, you know, my experience is that something will leak. You know, somebody knows somebody else who knows somebody else who knows one of your employees, and next thing you know, everybody in the office knows about it. Or, you know, somebody's accidentally CC'd in on an email that they shouldn't have been. And, you know, this can be a little bit of a tricky time, particularly if employees have found out. And then, you know, if competitors have as well, and they know some of your customers, then, you know, whilst you're months and months away from doing a deal, suddenly you've got another little fight on your hands, keeping the business at its previous levels. It might be that you want to sell to a family member. Now, you know, if you've got enough money to live off in retirement and everything's great, then potentially you might be just passing on the business to them. But maybe you haven't got quite enough, and you'll need them to keep paying you a monthly amount for a few years, or a lump sum, or whatever. A competitor is an obvious possibility. I gather that the code in the accountancy world is when one accountant rings up another and says, we offer then for them to meet up for a coffee. That is usually code for I'm interested in selling my business to you, or I'm interested in buying your business. So, you know, you probably know some of your competitors. If not, maybe you should perhaps find ways to get some introductions to them. Customers or suppliers are also potential buyers. You know, you might have a very successful customer or successful supplier who's got money in the bank, doesn't think that they can expand the business doing what it does, so they're looking for what's called vertical integration. So, you know, by buying out their customer, they can now make profit from your business as well. So, you know, those are possibilities, particularly if you've got some really close relationships with some of those. The last one is, of course, the management buyout, assuming that you've got some good management in the business that are capable of buying it out. The ways that they might do that is that management set up a new limited company, and that limited company contracts with you to buy your shares. There are some very good tax reasons why that might happen. I would suspect that you would probably need to agree some kind of deferred payment terms in that situation, because it's unlikely that they will have all the money to pay you or be able to borrow it from a bank. If you're going to agree to deferred payment terms, then you need to think about getting some personal guarantees in place so that you have a little bit of protection. Or maybe the other way of doing it is via an employee ownership trust, which is, of course, the main topic of this webinar. So, assuming the technology works okay, I think David's going to unmute himself and turn his screen on, and then when he starts screen sharing, I will probably disappear. There's David. So I will hand you over to David Rubin.
Hi, good morning, everyone. Thank you very much for that. We sometimes give a talk on employee ownership trust, and we say this is the best succession plan that no one has heard of, because 7 years since the law changed to allow these, there are loads and loads of people who don't know about it. A couple of weeks ago, we spoke to someone who'd spent over £100,000 on fees, legal opinions, etc., to do some sort of reorganisation that frankly was completely unnecessary. They could have done an EOT a lot more cheaply. We dealt with someone else who was doing a share buyback, and it wasn't really what they wanted. In fact, he wanted to stay on for a little bit, but as you might know, with a share buyback, once you've sold, essentially you can't darken the company's doors again. So he'd actually done something that commercially he didn't want to do in order to get a 10% tax rate, when he could have sold his company to an employee ownership trust at a 0% rate a lot more cheaply as well. So sorry, if I can just, so here are some EOTs that have taken place. Here are some that we've done. There've probably been about 500 EOTs EOT transactions done in the last 7 years, and we've done about 60 of them. Generally, it's got to be said that these are politically not very controversial. I mean, you'll see Richer Sounds here. Don't know if you saw this wasn't a deal we did, but Julian Richer sold his business. I mean, he must have got about 25 million or something, tax-free, gave a bit to his staff, and he was treated like some sort of cross between Albert Einstein and Mother Teresa. It went down extremely well. You can't imagine if he'd done a buyback or an MBO, etc. He'd have been treated quite so generously in the press. But one of the reasons why EOTs, I think, are an exit for the future is that when you look at what younger staff want, you look at the matters below. I'm not going to go through them line by line. But what you'll notice is that it's no longer enough to say to staff, and this is an issue in law firms as well, it's no longer enough to say, listen guys, work hard for a few years and then we'll make you up to partner and you'll make a lot of money. Millennials aren't quite as interested in that. They're in a few of these things, in sort of long-term stability and things like that, job satisfaction, positive culture, etc. They're not quite so keen to be sort of shouted out, for 10 years basically, but then be told, well, don't worry, because in a few years this will all be yours. And quite a lot of, and so one theme I'll be constantly referring to is that EOTs are good for recruitment. There's always a shortage of qualified staff, and you need to show how you're different from other people. And an EOT ownership is a good way to do that. So just going back then to the going back to sort of different types of exits, as we looked at before. Again, I'm not going to go through this entire table. I mean, it's worth just a couple of things worth mentioning on this. To get an EOT, you have to sell at least 51% of your shares, but generally you'd sell at least 75%. There has to be a true change of ownership as well. What you can't do is sell to a trust and then stuff the trusts with all your mates, basically, or make the directors of the trust company all your mates and then just carry on as before. MBOs were sort of referred to just before. Yes, obviously they can work. It's difficult to raise money, though, and often people won't want to take on the sort of the personal guarantees or mortgaging their house, etc., that would be necessary in order to provide the amount of cash that you want. Third-party sales, as we said, they're possible. They're often quite expensive. You need to pay agents, you need to pay your own legal fees, you need to pay the purchaser's legal fees, etc. It's also the fact that you lose quite a lot of control. I mean, we did an EOT for a company in the West Country. It was a logistics company. It was based in a village. It was the main employer in that village. And the owner said, look, I'm going to stay in this village. I'm going to be drinking in a pub with my former workers. If half of them get sacked, etc., they're going to come and knock on my door, and they're not going to be very pleased with me. So he preferred to do an EOT. He didn't even need to take quite as much money as he could have done from a third-party sale, but he wanted to have some sort of control going forward. Not absolute control, but at least to be able to keep his hand in. Liquidation, of course, is a possibility, but then you're making your staff redundant. You've got no legacy, etc. And often that's the reason why you set the company up in the first place. The other thing about a third-party sale, of course, is that you often have an earn-out and things like that. And that means you've got to stick around. You've got to stick to someone else's business plan. And again, often the reason why you set up on your own in the first place was that you didn't want to have to look at other people's business plans, particularly not at that stage of life. So employee ownership of the type that I'm talking about it's not direct holding by employees. It's holding by an employee trust. So the employee trust holds the majority of the shares in the company. And this was previously sort of called a John Lewis Trust before the Waitrose and things started having various problems. But it's not identifiable employee ownership. So it's not that any employee can look and say, right, these shares are held specifically for me. There's a set of shares held for the employees generally. So what's the benefit for retiring owners? Obviously, it's the legacy. Realise the value built up. There's often quite a lot of cash on the balance sheet because it's quite tax inefficient to pay yourself dividends and things like that. So often there'll be quite a lot of cash available, and this can be taken out generally tax-free. It allows time for leadership succession. As we said before, if you do a share buyback, then you basically have to leave the company and never come back. That's obviously problematic. Unlike the other things, it makes it fairly straightforward to allow key people to be appropriately rewarded. You can bring through sort of new management and a new team, and you can grant them options over the company, which means that there's still room for future growth. And the other point, but don't make this your prime reason, is that there is no capital gains tax. So it's a completely tax-free deal for the retiring owner. Now, some people are completely transfixed by that and think, wow, 0% will do it. Don't make it your prime reason. One or two cases where we've known it go wrong, where people have just said, right, this is what we do. I'll do anything for a 0% tax rate. And so they haven't looked at the rest of the deal and realized that sort of holistically it doesn't work. So that's the benefit for the retiring owner. For the employees, well, as we saw, sustainable ownership structure. You have a voice. There's some. You have a voice. There's almost always an employee representative on the trust board. Some engagement. Essentially, the company is, at least in theory, run for the benefit of the employees. There's a profit share because there'll be less money paid to the owners by way of dividends, and that means there's more available for the employees. And as we'll see later, some of it is free of income tax. And the other thing is that the employees have participation without investment. So because if the company was ever sold on, then the proceeds of sale would go into the employee ownership trust, and then they would need to be distributed to the employees. Now, at a time when particularly younger employees have got student debt and all sorts of other things, possibly mortgages, possibly huge rent, the last thing they would want to be doing would be to spend 20 or 30,000 pounds to buy into sweet equity or whatever in order to invest in the company. So they've got the benefit of participation without having to invest. And in addition, if they are granted options or if they are sort of given shares in the company, they can benefit from dividends and capital growth. No, I know it is possible, by the way, to have an offshore employee ownership trust to avoid capital gains tax going forward for the trustees. I don't think this is a good idea, although it is legal. The reason being that if the trust is offshore, then it's run by professional trustees, and I think it's better to be done onshore and more consistent with sort of employee engagement. So, how can this go wrong? This sounds a brilliant idea. You've got to engage your employees. That's the important thing, and you've got to make sure your leadership team is on board. You need to be able to be willing and able to let go. I think that's the main thing. I know we've discussed before that lots of people actually want to sort of give in the keys and never come back. But actually, we know quite a lot of people who they have to micromanage everything, and they have to come back and just sort of check that everything's being done. I think we all remember in the office David Brent sort of came back, and he came back with his dog, I think, and eventually they had to throw him out because it was so annoying. I appreciate he wasn't an owner, but it just shows that, you know, lots of people just can't actually function without being in their office, particularly, you know, where it's their business. So be willing and able to let go, and accept that timing for paying you out may need to be flexible. So you can always say, I'm going to take a couple of million now and take a few 100,000 per year tax free. If you have a bad year, then if the company has a bad year, you might well need to say, look, guys, I'll take a bit less this year, or even nothing at all, or even in some circumstances, I'll lend a bit of money back to the company in order to help out. So governance, well, as I said before, the employee trust is the majority owner of the company. The employee trust, I mean, it's basically a benevolent shareholder. It has a big stick. In theory, it could sack the entire board. In general, it wouldn't want to wield that stick. And generally, like with most shareholder documents, in the ideal circumstances, you'll put all the documents in the drawer and never look at them again. The time when you'd actually need to look at it would be, you know, if the company wasn't performing properly, and the trustee might need to look into things. I'm only aware of one situation where the trustee did actually come in and sack the board basically and bring in a new team to run the company. There were exceptional circumstances there, but I think the important thing is that it has the right to do so, which can't be excluded. And again, that's something that the owner just has to put up with. So some examples here. I mean, some of these may look familiar. Can't find a third-party purchaser. People don't want to invest or can't find the money to do so. Employees who know the business best, shouldn't they be the next owners? Or, and this is another possibility, we're not big enough for an IPO and we don't have the critical mass to attract a strategic investor. And included in that is, the amount of money we'd make isn't enough to make it, well, it means that the legal fees to do the transaction would be quite substantial compared to the actual value that I'd get. Employee ownership trusts are pretty straightforward to put in. You only pay one set of lawyers, one set of accountants, and because it's essentially a soft exit, it's generally a lot more straightforward than another type of transaction. You could typically get one done quite easily in 3 months, and that's including a tax clearance, which can ensure you that the tax treatment is what you want it to be. So we'll see very briefly here how it works. The retiring owners sell the shares to the employee trust. The company pays a certain amount of money up front if there's excess cash on the balance sheet, and then pays money out of profits over a time period to the employee trust, and those profits get paid to the retiring owners in installments, as we said before, tax-free. And the employee trust then owns the company for the benefit of the employees. As we said, created in 2014, 2 new tax reliefs were put in. You could have an employee trust before. That's how John Lewis worked. That's how Ove Arup and others worked. And there are some grandfathering rules on that. One point that's worth mentioning is there's something called a participation ratio for capital gains tax and income tax reliefs, because the revenue does not want to allow this sort of tax-free exit for family companies. So therefore, one of the rules is that the number of people who are shareholders and employees or office holders with the company must be no more than 2/5 of the total workforce. So, if you had four directors who were shareholders, then you'd need to have at least 10 staff, including them, in order for the plan to work. And that's assuming that no one's actually employing their son or daughter or whatever in the business. I was dealing with a company up in Lancashire the other week where where I thought that we were going to be okay on these ratios until the shareholders who at least were charitably at least 65. It turned out that both of them employed their parents, and there was also a brother, a sister, nephews and nieces, etc., on the books as well. So just be a little bit careful. If you've got a very small workforce and lots of shareholders or lots of directors, you may need to sort of have a look at that. So the tax reliefs are, as we said, 0% CGT for sellers, has to be a trading company, not a not an investment company. And if it gives shares out to employees later, this must be on the same terms. And we'll look at what the same terms means shortly. And here's another point: employee-owned company can pay up to $3,600 per employee, free of income tax, though not employers' NICs, on the same terms. So that means on the same terms, you'll see, can reflect each employee's remuneration, hours worked, and or length of service. So you could say to everybody, everyone's getting a bonus of 10% of their salary. And if you did that, the first 3,600 of it would be tax-free, and anything above that would not be tax-free. Similarly, you could say everyone can have £500 for each year of service. That would be lawful as well. What you couldn't do would be to say, you know what, you and you have done, and A, B, and C have done an excellent job this year. You're getting a bonus. E, F, and G have not done very well this year, so they're not getting the bonus. So that's what it means by same terms. It doesn't mean you can't pay other bonuses. I think sometimes people think that they can't make any other sort of bonus payment. They can. So you can have a separate bonus scheme which pays out whatever you like. But if you want part of it to be tax-free, then you have to ensure that you stick with the sort of same terms provision. If the company is sold off, so employees can acquire shares. The company can grant sort of options to the to staff. The EOT can actually transfer its own shares to employees, but again, it has to be on the same terms. That's, in other words, given out to everybody or given out on the basis that we discussed before. And on the sale of the company, similarly, all qualifying employees would share in the net sale proceeds under the terms of the trust deed. Generally, that's what's allowed. Very occasionally, if you really don't want the company to be sold on because it's sort of legacy business, then you might provide for the proceeds to go to charity. That's quite unusual, though. So when is an EOT suitable? Well, you have to be confident that employee ownership will work. Well, it has to be the best. Well, it will be the best succession solution compared with the alternatives. Now, of course, what are the what are the alternatives? Well, that might be quite an interesting question. We've looked at that before. What I would say is that it's important to know about these things, because even if you don't actually do it, let's imagine you've got one buyer who wants to buy. Obviously, if they know that they're the only game in town, then they might well be tempted to impose all sorts of conditions that you don't like very much. If you can say, listen, guys, I don't have to put up with this. I could sell to an employee trust. It would be a soft exit. I wouldn't have to put up with any of this nonsense. Then at the very least, this gives you a decent negotiating position as against your buyer. So it's a useful thing to know about employee ownership trust, even if you actually don't put these things in. Management support, that's obviously quite important. It's a mistake I found to assume that people will want to take on management positions. Again, we've had situations where you've got someone who's very good at their job, and you just sort of assume that they'd want to step up to the plate and become managers, and actually they say, no, I want to be home at 5:30, and have my dinner on the table, and I'm actually not interested in any sort of management position. So make sure you don't find yourself relying on this sort of person without checking. Again, employee engagement, it should be a positive thing. There's tax-free amount available. If you'd sold up to a third party, the employees would likely not have got anything else out of it. now, if the company is sold on, they'll make quite a lot of money and they don't have to invest anything. So from that point of view, it should be a purely positive thing. But the only time when it can go wrong, as we discussed before, is if there's some sort of if there's some sort of leak or whatever, and there are rumours and things like that, and then you get a sort of two-tier situation where some people know about it and others don't, and then they pick up rumours and this and that and the other. So when is it different? When would an EOT possibly not be suitable? As I said, if you do it only for tax reasons without any idea that employee ownership could work, sometimes there's not enough cash available to fund the purchase price. That could include if you sell on, on too ambitious a multiple, and what that means is that the company is in hock to you for the next 20 years, and there's no money available for employee bonuses or anything like that. So you need to be realistic, let's say, with the price that you get. Again, management need to support it, and won't. The management, in effect, your ambassadors. Again, it's the case. Sometimes people don't have a next tier of management available, and then it can be problematic. So what happens? What if you have a company? You think, what, we can think of this company might be suitable for an EOT. What can you do? Well, you can obviously make sure there's some sort of succession plan in place. Consider building up cash reserves. I mean, it's a bit silly paying paying £500,000 dividend, let's say, 1 year, if the next year you could have added that to the purchase price and taken it tax-free. So consider, if you are sort of considering doing this, you might not pay a dividend or sort of reduce bonuses that were paid in order to build up cash reserves, because these could be paid out tax-free. Ensure you pass these sort of 2/5 ratio tests. I was speaking to someone yesterday, in fact, and both the two shareholders, well, there were 4 shareholders, which was sort of 2 couples, and it turned out that they would have failed these participation ratios because there were only 8 members of staff. So the consequence was that they would probably have to sack their spouses from their jobs, because that would then mean you had sort of fewer employee shareholders, and therefore you would sort of pass the test. You have to fulfill this for 12 months prior to a transaction, by the way. So we're preparing the ground to do the deal next year. Of course, what he then said was, well, David, I assume you'll act for me on any unfair dismissal claims that our spouses bring, to which the answer was no, unfortunately. But do have a look, because it might well be that you might need to take on an extra staff member or do something like that to deal with it, and check for any other obstacles. I mean, just as there are, sometimes of obstacles. We're acting at the moment for a franchisee, and the franchisor has said, what, we're not that keen on EOTs, because we expect there to be one owner. We expect it to be an owner-managed business. We expect there to be one person at the top. And if you have an EOT, there isn't one person at the top. It's an employee-owned business, and they weren't very keen to do it. I mean, in the end, we managed to persuade them. Otherwise, it took quite a long time. So sometimes where you've got a franchise or franchisee relationship, it might be it might require a lot of a certain amount of sort of groundwork before. So that's all I wanted to say about this. These are the details. We're a small practice. We've got 5 lawyers, and all we do is share schemes. So anything involving shares and employees and companies, we're involved in. We're always happy to have a chat to people about sort of anything related to share schemes, and obviously we're very happy to work with A4G on these matters. So I'm going to again use my technology to okay.
Hi, David. I'm back. We've got a few questions and answers. A few questions in the the Q&A box. Hopefully you're going to provide the answers. So I'm just going to run through those. I've got a few questions of my own as well that I'll throw at you. So one of the questions, if I thought a business looked suitable for an EOT transaction, how could I kick off the process? So I guess if that's from one of our clients, then probably have a chat with your principal advisor at A4G first. But from your point of view, David, how would you answer that?
Okay, so the first thing is that you need to be realistic about the valuation. It's it's no good thinking that I'll sell my business 15 million quid. If it turns out that that it's going to be valued at 3 million. You do need to have a proper sort of external valuation in order to do the transaction, mainly for the protection of the trustees, if nothing else. So yes, go and speak to your sort of principal advisor. Make sure that you've got at least a realistic idea about what the transaction is going to be worth, and do a bit of financial modelling, which again is something that Malcolm can help with, to make sure that the company will be able to afford the repayments. And that sort of thing. And the points that I put in earlier are sort of relevant. Just make sure, for most companies, like if you've got 30 staff members, it's not really you're not going to have a problem with the participation generally. If you've got single figures of staff, then you might need to look a bit more closely at at your participation ratios. And it might be in some cases people bring on people who are subcontractors are brought in as employees and things like that, or maybe if someone's got a spouse who does a little bit of marketing or something like that, it might be possible to take them off the books or something like that, just as a sort of matter of preparing the groundwork going forward. So yeah, I thought that's it.
Yeah, but I suppose what I'd add to that is that it's having that proper discussion about all of the options, and the valuation model that we've got is we designed it so that we can actually sit side by side with our client and run through the numbers, because it steers you towards thinking about possible buyers of the business and what they might expect, and I guess from David's point of view, it probably avoids us introducing clients for whom this isn't going to be suitable, who've got better options really. So yeah, I think that valuation is critical, because it, as I said, it ties in with who the potential buyers might be as well. The second question was, how would this work in a structure where there's a holding company? So I guess that's where a previous deal has perhaps been done. There's a holding company owns the business, so the employees are working in the subsidiary whilst the owner owns shares in the holding company.
That's absolutely fine. There's no problem. You can do this in a group as well. It's just the tests for the ratios and things like that apply to the group instead of to the company. So we've often done a case where there's been an MBO or something like that previously, or for one reason or another there's a holding company. But it's no problem at all if the employees are in a sort of subsidiary. And if you've got a joint venture or something like that, or it's not 100% owned group, it can be slightly more complicated. But provided that there's just a holding company and a sort of wholly owned subsidiary, then it's no different from doing a normal a deal with a single company.
Brilliant. All right, and that sort of ties in nicely. One of the other questions is on a management buyout. I think this is probably to do with my bit of the presentation. Can you explain why they would need a company to buy the shares? So, so this is nothing to do with employee ownership trusts. If a group of individuals or one person wants to buy shares in another company, then the best way for them to do it is to set up their own company. That then buys the shares. So on paper, let's say it's £1 million that they're paying, and then potentially now they own the shares in that trading company. Perhaps they could take a dividend out for any spare cash out, and a dividend from one company to another company is tax-free. Then going forward, they'll need to take that dividends out of that company to repay bank borrowings, or maybe if it's a deferred purchase arrangement. And again, if the dividends from the trading company are going into another company, there's no tax on that. If they've bought the shares personally and they've got to pay back a bank loan, then every time they take a dividend out of the new company they bought, they're going to get hit for 7.5%, 32.5%, or even 38.1% tax on taking that dividend out. So, all good accountants would recommend, if you're buying a trading company, to set up another company to buy it. So, sorry, David, that's I thought that was a good point to just jump in and answer that question, because it tied in with your previous answer.
No, absolutely. No, that's fine. And of course, with the holding company, you can get people to reinvest a proportion of their proceeds in the holding company going forward, or roll over their shares. But no, I agree entirely.
Okay. The next question, you and I might give different answers to this because we might be coming at it from different angles, but it says, can the company still make pension contributions to the retiring director ongoing?
Well, if it was still an employee, it was still employed, I suppose. Yeah, I suppose they could. Yeah, I didn't.
And they can still be an employee with responsibilities.
Yeah, that's right. Yes, I mean, if it was still employed and you've got responsibilities and things like that, then I don't see why you can't. I mean, bear in mind that it would need to be done. That everything has to be done more or less on a sort of arm's length basis. So it can't just be the situation like, oh well, I'm used to getting a 40 grand pension payment just because it was my company. So it would be something you'd probably need to justify to the EOT. It might be difficult to justify if no one else was getting any pension contributions at all paid. But you could, in theory, hard bake it into the transaction that, oh well, that's you'll continue making a 40 grand payment. Of course, that will reduce the price of the company because you'll be selling a company that's got a liability to pay 40 grand into his or her sort of pension. So I think in theory you could do it, but it would have consequences. Do you agree, Malcolm?
Well, funny enough, I was looking at it from a tax point of view, and I would have given exactly the same answer as you've given, which is, so from a tax point of view, we just assume that pension contributions paid by a company are tax deductible, but all costs that a company pays out to be tax deductible have got to be, the phrase is wholly, exclusively, and necessarily for purposes of business. So it's the same criteria. If the person you're paying the pension contributions is not actually working there, then the pension contribution isn't tax deductible. So probably the tax man and the trustees would view it in exactly the same way. So yeah.
Okay.
Good. So the next question was, what size turnover do you need?
Okay. So the smallest EOT that we've ever done was about £300,000, but that's not turnover. That was that's the entire company value. Obviously, the benefit of the EOT, the tax-free benefit, is that you pay tax at 0% rather than 10% you'd pay otherwise. So I suppose if it's less than £500,000 that you're receiving for the entire company, you consider whether it's worth whether the benefits of doing the EOT are worth the sort of statutory sort of regulations that you have to stick with. But we have done a few around the sort of £750,000 mark. So I think it's more sort of what the company's worth rather than the turnover. But yeah, I'd have thought, probably going to be marginal below a value of £500,000, but we've done quite a lot, just above that level.
I think what we found when we started looking at the EOTs is that initially the companies that were doing what David does were very big organisations, perhaps listed, and some of the fees that they were charging we thought were astronomical. And at that point, of course, the cost of doing it means that for smaller companies it becomes a bit prohibitive. So which is why we sort of did a bit of a search. Amanda, who organised the webinar, went on a bit of a hunt for us to find what we thought was the best provider of EOTs, which is how we ended up meeting up with David. So the smaller the company is and the smaller the sale value, then proportionately the higher the cost, really, I guess, isn't it? So,
but equally, I suppose that, if you did some other transaction, the people who did this sort of £300,000 transaction, well, if they sold it to another business, they'd have had to impose, they'd have had their lawyers, they'd have had agents' fees, the buyers would have had their own, their own lawyers. So, the fees could easily have, just on the agents' fees alone, might well have exceeded what our fees were on the transaction.
yeah, very true. So, got a couple of other questions, but lead us on to the whole new sort of area. At what point do you discuss this with the team? And if they say no, they will all know that an alternative sale is imminent. So, this is where we get to the human aspect of.
Right. Okay. So it depends. There's the team, as in the people who are the management. Sometimes there's a management team, as I said before. Sometimes there's a management team in place already who are, running the company. I would tell them reasonably early, because their buy-in is going to be needed to make some sort of transaction. I wouldn't necessarily tell all the employees right at the beginning. Typically we wait for tax clearance to come through, because when you've got your tax clearance, you basically, that's the last obstacle. So typically we'll tell the management team, fairly early. And when it said if they say no, you're not necessarily saying to the management, I suppose the question is, what would happen if the management team said no? Well, you could say, listen, managers, here's your possibility. Either you each stamp up 250,000 quid to buy me out, or I do an EOT. So when they say no, I suppose it depends what the alternative they're being offered is.
Yeah.
But I would try to I wouldn't necessarily go and say, we're definitely going to do an EOT. I'd definitely say, listen, I'm looking for some sort of exit, and here are the possibilities, because ideally, obviously, what you want is for them to say, well, actually, it sounds if an EOT's the way forward, and for them to think it was their idea rather than yours necessarily.
Yeah. I what sort of, I imagine you must have had a few challenges on that front with one or two of the other EOTs, or do you sort of find that the management team are always enthusiastic?
Well, they're enthusiastic, I suppose, because the alternative is that they, take out a mortgage on their house or come up with 250,000 quid.
Or get sold to another company.
Yeah, or get sold to another company, in which case, for them and for the staff, it's a period of uncertainty. So from that point of view, I would have thought it's generally, when it's properly communicated, I would have thought it ought to be a almost completely positive thing.
Yeah, I think that sort of ties in. I always say, that people always prefer choice, and I go back to when my eldest child was very young, and her mum said to her, do you want the nice blue one or the horrible green one? And it's a nice blue one. Whereas, even with the employees, we go back to what are all the alternatives here, and if they feel they're being forced down one route and one route only, then you might get a bit of resistance. If they feel that this is one of four routes and it's the best route, then it's human nature is that I'll probably view it more positively.
Right. Okay.
So one of the questions as well: are all employees created equal within the trust? Do those just starting out also join? What happens if people leave? Do they expect a payout?
Right. Okay. So no, you can exclude people who've got less than 12 months service. If people leave, they might expect a payout, but they don't get one. Once they've left, that's it. They don't join in. They don't get any payout at all. So that's why it's reasonably, if you had a situation where you had 90 employees each holding a share, and each holding a number of shares, and you had a turnover of 15 per year, you can imagine the general hassle of trying to buy their shares off them, do a valuation, buying them back, giving them to somebody else, and that makes it a lot easier. So the employees, if the I said before, it's if you pay benefits out of the trust, it has to be done equally, but equally doesn't mean everyone gets exactly the same amount. It's just, it has to be based on, if they don't get the same amount, it has to be based on sort of salary, hours worked, or length of service.
Yeah. Okay. What's the most common way? Or is there sort of a formula that incorporates all of them?
I'd say probably salary is the most common. I think it's easiest to say, look, 10% of your bonus is 10% of salary, and I think that's That's the easiest way to do it. People do make the most incredible spreadsheets of, well, you get 6 points for each year of service, and then and then whatever it is, and then put everyone into salary bands, and then add the points to the other points, and then add another 3 points for each day of the week. And I just think for 3,600 quid a year, it's just a lot of hassle to go to.
Yeah. So what once the business is in there, I mean, is there ever the possibility of selling the business to a third party?
Yeah, absolutely. I mean, yeah, absolutely. I mean, it can be built up and then sold on. So there's nothing to stop that. And of course, that's the advantage for that's what the employees can be in it for. They can think, if we can sell off this business, if we can build it up and sell it off, then if there's 10 employees, then in theory, they'll get 10% of the net proceeds of sale once it's sold. Once it's sold on.
Even if potentially they've only been there for a week or a year.
They don't have to be there for a year. Yeah, I mean, again, if it's done per year of service, then it won't be. But in theory, you can't exclude anyone from the payout if they've got more than 12 months service. Yeah. So so depending on how it's decided by the trust, they'll definitely get something out of it, which is more than they'd get if it was sort of sold on, by the immediate, by the initial owner.
And presumably the board in that situation, if the board wanted to actually buy it themselves, almost do a management buy, they could then buy it from the EI.
Yeah.
Okay. Just on that front, what happens if presumably, we're going to be paying over a period of time. What happens if the owner dies during that period of time?
Well, if the owner dies, then the amount owing to the owner will be part of the estate. It will be subject to inheritance tax in that case. So it's not a brilliant inheritance tax sort of save. It's not a brilliant tax saving device for inheritance tax purposes. But on the other hand, that would have been the case for any sale. That if you hadn't sold the company, then it would have been a business asset. And not part of the estate. If you sell it, it will be part of your estate. But I suppose you could take out insurance, in case you have to pay inheritance tax.
And just getting down to the nitty-gritty, one of my clients asking, what would be the sort of fees for a transaction of this nature?
Well, I mean, I think it sort of depends on exactly how the transaction works. I mean, typically would work with an accountant on this. And certainly with A4G, we'd sort of try to sort of work together to make sure there wasn't any duplication. But it's not. But we wouldn't do it on sale as a percentage. It would be, it would be a, it would be, on an hourly basis essentially. But worked out into what would generally be a fixed fee. I mean, look, just as a very rough estimate, you might be looking at, for the legal fees, you'd probably be looking about probably 25,000 maybe plus that. Depending on how much of it we were doing, how much of the clearance you were doing, etc. But that is a very, very rough estimate. I think that might be what you're looking at for the legal aspects of it.
Yeah. Okay. And there's a question about, you still have a board of directors, and obviously the company still has a board of directors.
Yeah.
Buyout has trustees.
Yeah.
Can those be exactly the same people, or does there have to be an overlap? Or
legally, they can be the same people. From a governance point of view, it's probably best not to be, because essentially they would be, marking their own homework. So the seller, for example, might want to stay on the board and might also be the seller representative on the trustee board. There would also be an independent member of the trustee board, typically an accountant or something like that, and there'd be an employee representative. Ideally, the employee representative wouldn't be someone who's on the board of directors. A lot of companies have got someone who they think, what, this person hasn't necessarily got sort of leadership skills or anything like that, but they'd be pretty good at doing the sort of auditing aspects of being the employee representative, and they'd be a good, candidate. So there'll often be some overlap, but there shouldn't be too much, if possible.
Brilliant. I think we're sort of out of time there, really. I'm conscious that everybody's probably blocked out up to 9:30 in their diaries. So that's absolutely fabulous, David. I really appreciate the presentation today. As I said, for those of you who are clients of A4G, if you've got some specific questions, feel free to ping them direct to David, or ping them to your principal advisor at A4G. If you're not a client of A4G, you know where we are. Hopefully, you picked up our email address along the way. So, I'm sure we're going to be having conversations with quite a few clients over the next couple of years, David. So, really appreciate your time today.
Yeah, pleasure.
All right. Thanks, everybody. All right.
Thanks,
See you soon. All right. Bye.